Hello everybody, welcome to the core content lecture. This one will be focused on the continuation model. So getting right into it with the swing trader. So the swing trader sequence is a weekly time frame gap, a daily time frame TPD, and then a 4-hour entry technique. So as you all know with the same diagram from the last core content lecture, you'll have that fair value gap, in this case being a weekly time frame fair value gap, and then a daily time frame TPD following shortly after inside of the gap, and then within that daily time frame TPD you'll have a 4-hour entry technique. Now something to keep note of with the entry technique, in the last core content lecture I stated that you need a fair value gap as well as a breaker overlapping each other for a high probability entry technique. Now while that is extremely precise and the best case scenario, if you are somebody that doesn't like trades running without them, and you're not somebody that likes too many moving parts within a model, a simple break of structure for your entry technique works fine as well. And that works for all of the sequences that you will see throughout this lecture. But just keep in mind, if you simply use a break of structure, it won't be as precise compared to a fair value gap and a breaker overlapping each other. So now looking a little bit closer into the swing trader. So the criteria is you are targeting previous weeks and months, highs or lows, and your stop loss is slightly above or below the daily time frame TPD. And the specifications is a true reversal or weekly time frame TPD has already kicked off an expansion. So the swing trader sequence for this model is one of the least occurring sequences throughout the entire year. So you're really going to need a clear-cut true reversal or a weekly time frame TPD that kicks off that expansion. So don't expect this sequence to form too many times throughout the year. And now looking at the short-term trader, so the sequence that the short-term trader uses is a daily time frame gap, a 4-hour time frame TPD, and then a 1-hour time frame entry technique. So again, looking at the diagram, we'll have a daily time frame gap, and then dropping into that gap a 4-hour time frame TPD, and then a 1-hour time frame entry technique. Now looking a little bit closer, the criteria is you're targeting previous days or weeks, highs or lows, and your stop loss is slightly above or below the 4-hour TPD. And the specifications for the short-term trader is a true reversal or intra-week timed true reversal created the daily time frame gap, and the highest probability TPD will be of the order of operations 2 a.m. 4-hour TPD. Now it can occur with any of the 4-hour TPDs, but just keep in mind the highest probability ones will be within the 2 a.m. 4-hour TPD. And you guys already know why. So now looking at the day trader. So the day trader sequence is a 4-hour time frame gap, a 1-hour time frame TPD, and a 15-minute time frame entry technique. So again, looking at the diagram, we'll have a 4-hour time frame fair value gap, and then a 1-hour time frame TPD, and then a 15-minute time frame entry technique following subsequently. So looking a little bit closer into the criteria, so for the day trader, you're targeting previous sessions and daily highs or lows, and then your stop loss is slightly above or below the 1-hour TPD. And the specifications for the day trader is a true reversal or intra-week timed true reversal created the 4-hour gap, and you're expecting the day to serve as a fast continuation expansion towards the higher time frame draw. And you're looking for the order of operations 1-hour TPD, and the best 15-minute entry techniques will form post 8:30 a.m. So this sequence or this model is best used on those continuation days where a time true reversal has taken place and a Kraken correlation is formed, and that day doesn't really expand as much, but it leaves a gap. That following day being the day where you're expecting the day trader sequence to form. This is one of my favorite day trading models. If I were to only trade something in regards to day trading, it would be this exact model right here. You wait for the 4-hour gap, and then you wait for the 1-hour TPD within the gap during the order of operations time, and then you're looking for that 15-minute entry technique after 8:30. So now looking at the session trader, so we're not going to focus on a scalper for this model because I don't think it's necessary for a continuation. So the lowest we'll go in this lecture will be a session trader. So the session trader uses a 1 hour time frame gap, a 15-minute time frame TPD, and then a 5-minute time frame entry technique. So again, we'll have a 1 hour time frame gap, 15-minute time frame TPD dropping inside of that gap, and then from that 15-minute time frame TPD, a 5-minute entry technique. So diving a little bit deeper, the criteria is you're targeting previous sessions highs and lows, and your stop loss is slightly above or below the 15-minute time frame TPD. Now the specifications for the session trader is this is best used when you're expecting a London continuation and the higher time frame is unclear. And the order of operations 15-minute time frame TPD is what is best used, and then the best 5-minute time frame entry technique will form during the 9 a.m. hour. So if any of you have wondered, Jacob, why in the tape readings do you wait until the 9 o'clock hour to drop down into these lower time frames? Well, this is exactly why right here. And the session trader, if London expands without any real reasoning and the higher time frame is unclear, if you're expecting a continuation off of London and you're not expecting a reversal, then more times than not you will see this sequence play out. But anyways, hopefully you all found this one insightful. I will speak with you all again soon. Good luck and good trading.